Hello, welcome to the Market Carver. I'm Adam Harter, Chief Investment Officer, along with Andrew Thrasher, Chartered Market Technician and Portfolio Manager. Thank you, as always, for giving us a few minutes of your time where we try to break down some of the topics that we discuss in our weekly allocation meeting. So the three topics we've got for you this week, we're going to talk about how bonds typically do when a Fed pivots on Fed policy. We're going to look at another line on these stocks that have really driven the market and what they are worth from an overall value perspective. And then we're going to take a look at the credit cycle and individual credit applications. So we'll get started right off here with the bond performance when the Fed typically stops the rate hike cycle. So why we're talking about it this week, the Fed is going to meet and by and large expected to raise interest rates by another 0.25%. And there's better than decent odds that this would be the last hike for a while. It's not set in stone. If recent meetings were any guide, then perhaps they leave the door open to continue that hiking down later this road. I think that's also very likely. But at this point in time, it could be the last hike in the cycle. And so what we're looking at here is a history of the past 30 years or so. When the Fed stops raising interest rates, what happens to bonds? And there's an old mantra that says, don't fight the Fed, which simply means if the Fed is cutting rates, and this works not just in stocks, but it works in bonds, that when they're going one way in policy, you don't go and fight them and try to swim upstream. And so for bonds, that means when they're cutting interest rates, bonds typically do well. So you want to be participating in the upside, or when they're raising rates, which is what we've seen drastically over the last year and a half. That's when you want to be out of bonds. And boy, that's certainly been the experience. But typically once the Fed stops, we do tend to see positive performance from bonds going forward. So we've got short-term bonds, that would be your 1 to 3 year index. You've got your 5 to 7, that's more in the middle part of the yield curve. And then the long-term treasuries, and both on a 3-month basis, 6 and 12. So pretty healthy outlook across maturities and across the time frame. Bonds tend to do good when the Fed pauses. And of course, when they cut rates, they typically will do even better, though it's mixed by maturity and there's a little bit more unevenness in the performance. So who knows? You only know this in the rearview mirror. In each of those instances, you didn't know it was their last until after the fact, but we very well could have this change in environment. Time will tell on that. So that's it on the bond side. Andrew, I'll pass it back to you to cover these stocks and really a stunning comparison.
Yeah, so we have the first chart. We'll throw that up on the screen here for you. What we're looking at, there's a lot going on here, and so I want to give you a chance to kind of digest it. But it's really, really interesting. We've spent a lot of time this year talking about how the rally in the markets really was guided and really was the result of just a handful of stocks that have moved higher. This group gets named different things: the Magnificent Seven, FANG, the Elite Eight. It kind of depends on what analyst is writing a report, what name they'll use. Here we're getting a chart from Ned Davis Research. They're calling them the Elite Eight here. And what it's looking at is the value of Facebook, Amazon, Netflix, Microsoft, Apple, Google, Tesla, and NVIDIA. Some of the largest companies in the U.S. stock market today, and combining their entire market capitalization. And what they found is these companies combined actually right now are, according to the stock market, worth more than the entire energy, materials, industrials, financial, and real estate sectors combined. We can see the blue line on the chart. If we take a zoom in here, we can see on the far right side, we can see that blue line, which is the composite performance of, or the composite value of all these stocks, actually exceeds now these entire sectors, which is pretty extraordinary. Just have a handful of stocks, just 8 stocks, worth in more than in huge parts of the entire economy. What this tells us is that I think we are seeing, getting to the point where this is getting a little ridiculous. Can it continue? Of course it can. We saw a great example of that in the 90s and 2000 and into 2000, where valuations got extremely high. And so it's something that has continued, but we're seeing the point where we actually think there's now opportunity in some of these sectors mentioned here. we're continuing to look for opportunity in places like industrials, energy, different financials, and looking for maybe things that are maybe undervalued after the market's been so heavily focused on just these handful of stocks. So we found this pretty interesting. Just a handful of stocks now worth more than entire sectors. Now we're going to shift focus from the market. We're going to start looking at some of the economic data that we've gotten here recently, and this is looking at credit applications. And so looking across different forms of applications, when people submit for either a credit card or a mortgage or maybe a new car, they're all submitting these applications to banks. And what we're seeing now is actually banks are rejecting a higher percentage of credit applications. Now, part of this is due to just the overall credit profile of what the applications they're getting. It also is partly a result of this, the higher interest rates are having an impact on this as well. But what we're seeing on this chart, as we can see in the blue line on the top, we went from 12% of applicants last year where we're getting rejected all the way up to 21% in the most recent data. Now, we've also seen a decline in credit applications as well. We've talked in the past on the Market Carver of how consumers, by and large, actually are in a pretty good spot financially when we look at some of the national data as far as debt ratios, amount of cash, things like that, just because we had such a low interest rate environment for so long. But now we're starting to see those that are starting to go to banks looking for maybe to buy a new car, buy a mortgage, different reasons you may be seeking credit, we are seeing an increase in rejections there. And so that might be telling us that there is now starting to get introduced some stress on the consumer side, that maybe their financial pictures are starting to change. Now, this is just one piece of data. We want to look at everything as kind of as a whole, as a weight of the evidence. But from a credit application side, we are starting to see a little bit of stress there as banks are starting to be a little bit more particular with who they're giving credit to going forward.
Yeah, very well put. And one more piece that is just interesting to me, at least at this point in time, there usually what you have is an economic cycle and a credit cycle that are functioning together. But we're very clearly here one where the economic cycle is continuing on, and by that I mean unemployment staying low, and we're chugging along in terms of the overall numbers. But beneath that, there are more and growing credit, both on the consumer side and riskier companies. So those two can't stay diverged forever, right? As a strong economy kind of bails out that, or vice versa. So very clearly something that we're watching each and every week, both through these measures and also very directly through our risk barometer. And as changes continue to sink in there, that certainly weighs on how we're positioned within our portfolio. So, hey, thank you once again for giving us this time. As always, don't forget, you can reach out and give us a buzz. Come in and see us, 800-928-4001. Or scan the QR code and book it electronically. Either way, we appreciate you and have a great weekend.